Welcome to Triathlon Partners TV. This is Ira Koyner, the original IRA. Today, I want to discuss equity market performance this year, since Election Day, and over the past month, right? It's been a very, very good year, very solid year. And I think it's important to dissect what's happening because there's still a lot of opportunities, because those who think the market has just gone straight up uh, might be a little bit surprised by the findings we have, and they might want to consider chatting with us and setting up an appointment. Now, we're going to go into the reasons, or what I believe are the reasons why these moves have happened. We're going to get a little bit granular into it with the different sectors and the indexes, and we're going to go into where from now what I think are good investments going forward for the new year, and what to look out for and how and for markers to how to change your position and investments. Right. So this year has been phenomenal. There have been some really massive outperformers. We're talking about the S&P 500's up over 26%, the QQQs, the NASDAQ 100 up over 29%. We got the Russell 2000 up 11%. It's an above average year, not super fantastic, but all this is really great. But let's sort of keep in mind and break this all down. And we want to go, what we want to really know is we had the election. A lot of information comes out on the election, right, in terms of policy that might go forward. And then we also have interest rates. We had a big interest rate decision this past week or the previous week out of the Fed, where the market was expecting, yes, 25 basis point cut. They delivered that cut, but it was called a hawkish cut because the market was expecting 4 more cuts next year, right? But the Fed put some cold water on that, and they're saying they only see 2 cuts for next year. So that changes a whole dynamic of what stocks should perform well based on interest rates, right? We had a dissenter on the vote for one of the cuts. It's a first time voter. She won't be voting next year because of the way the different presidents vote of the Feds. They take alternating years, but but there were other people who didn't vote this year, but will vote next year, who also gave the impression they would dissent, right? So when we look at what really had great years, we're talking about industrials, financials, information technology, discretionary spending, utilities, communications, great years, right? Fantastic years. We're talking 18% over up to 30% years, right? Then we're looking at things that were flat. The good part of the market was flat. You're talking about real estate, energy, healthcare, materials. And the only thing that had about an above average year was consumer staples, about 10%, which is great for consumer staples. But when we look at this flat for the year, we want to sort of look and up for the year. Fantastic. We want to see how these things performed previous from the election onward, and also just for the month of December when it has that interest rate component, as well as a lot of end of year trading where people might want to take profit, might want to take against some losses they might have. There's a lot of rebalancing from equity portfolios, equity managers out there. So there's a lot of noise in there, but we try to break that down here. So what we've seen is went through what went on for the total year. All right, total year. So it includes the last 2 months. But then let's look at some anomalies I found, right? Well, we had that the financial stocks, they did really well this year, but they're down 4% this month. But they're still up since the election. Now, that tells you one thing. There's going to be, or expected to be, a lot of regulation changes, as well as in the IT industry, but which propelled the stocks higher. Companies should be doing better, but interest rates won't be going down as much, which is not great for banks. It's not as great for their balance sheets. They can't lend money. And from that standpoint, they can't lower the deposit rates that they pay you versus they've already fixed all their their lending rates at high levels, but and the increased transactions that will go on with lower rates as well. So it's not as great as it wasn't a super strong finish for banks, and that's because of the interest rates. The same thing happened with real estate, right? Down 9% this month. Happened with materials, down 10% this month, right? It happened with utilities, down 8% this month. Those are big moves. That's for the month, right? So, these things all move back to flat for the year. So they were having solid years. So we have to really keep in mind that interest rates are really driving this market, right? You're going to have some stuff with the new administration, but interest rates are the key. Then we're going to look at what happened with some of these. Before that, we also have to keep in mind there's some big current events. Healthcare, flat on the year, right? And a lot of that last sort of month or so, there's assassination of the president of United Healthcare. Really took a beating on stocks in that sector. People really maybe they think there's going to be some changes from the government on what they can charge and what they can. Who knows? But there seems to be some changes there, as well as we're going to touch on Elon Musk and Tesla, because he seems to have the ear of President-elect Donald Trump, right? So let's go into something a little bit more broader view. When we look at the S&P 500, right, had that great year, NASDAQ as well, but the S&P 500 is flat on the month, right? But it was since election day, it's up, right? Like 4%. And we're going to look at the NASDAQ is up 7.5% since election day, up 4% for the month. So the NASDAQ 100 is a smoother move up. And something else to keep in mind is small caps are very interest rate sensitive. There are also some things about it we'll talk soon, but they're down 7% this month, right? They're still up 10% this year, but they give back almost half of its yearly gains in the past month, and that's because of the interest rates, right? So when we think about that, we have to think, well, interest rates, it was supposed to be 4 cuts. They're only pricing 2 cuts. To me, these things are going to change on a drop. Like the wind blows one way or not. You get a couple of low CPI prints. Maybe you get a slowdown in the economy a little bit. These things tick down. It doesn't look hot. These things can change very quickly, the sentiments. And that's why it's important to keep in mind, because when we've seen these moves in a month, if they start cutting rates and predict 4 cuts or 6 cuts, you're going to see those sectors flip, right? You're going to see a very big move. If you had 8% down moves this month, it's not unrealistic to see those things fly back up 15%, right? It's very important to keep that in mind. Now, something else that's very interesting is Tesla. Tesla stock has been on fire. It's up 80%, I believe, since the election. All right. That's great. Great for people who hold Tesla stock. But what impact does that have on other indexes, on the big indexes? Because it's a big company. It has a big weight in these index. It really drives the performance of those things. Like, for instance, Tesla, I believe, right, it moves, we'll say is about 3.5 to 4% of the QQQs of the NASDAQ 100. It's, I believe, about 2.5% of the S&P 500 over the course of the election till now. It's a little bit higher now because it keeps on going up. And it's 20% of the consumer discretionary sector, right? That's massive. Now, when something moves 80% and it has that significant of a weighting in these indexes, right? Tesla's about counts for 3% of the move in the QQQs since election day. It's only moved 7.5%. It's 3% is Tesla, from my calculations. The consumer discretionary is up 15% since election day. Tesla's about 13% of that, not 13% of the 15%. So 2% is everything else. And then we have the S&P 500. It's up 4.2% since election day. This is about 1.8% of that. So we have in the larger indexes, 40% of the move is Tesla, right? So when we look at these things post-election, and we see what a big outside influence just Tesla has had, and we see what the rates market has actually done, and we see what an impact that has had, we've really sort of stalled here in the market. Doesn't mean it's going down, doesn't mean it's going up. We just got to be aware of those sort of things. So what are the trades going forward, right? Well, part of diversification that we talked about in the last video is, well, Tesla is such a large part of the QQQs. Maybe let's take apart the QQQs and maybe just get involved in the IT part as opposed to the consumer discretionary part, because there are other big companies in the QQQs and the consumer discretionary. Amazon is also 20% of that index. All right. And you got a good number. You probably have the top 10 stocks are probably 65% of that. Now, small caps, right? Even though interest rates really really hit this sector, what's very important to keep in mind is small cap stocks always do extremely well in the first year of a presidential term, right? Why is that? Presidents come in, they think they have a mandate. They usually have some extra support in the Senate and the House. The House might be a bit difficult this year, but guess what? When they pass budgets, every party loves small businesses. They're like babies in sunshine. A politician can't say they don't love them, right? So they try to throw some incentives out there. That should really help. It could be depreciation, it could be tax credits, it could be tax cuts, whatever it is. So something like that, interest rates plus a new government, if they both go well, that can really outperform. Fantastic, right? You have to be very agile and nimble with watching where interest rates are doing and making sure you can go back in and out of those sectors we spoke about, right? Okay. And also, thirdly, sort of broadly, but I'm touch upon, there are alternative types of investments that you have to look at, because diversification is not just stocks or bonds. They're not just different sectors. They're also different products, because different products have components which could offer protection in down markets to guarantee your principal in some cases, and over time, increase your participation and your returns better than the index does, as well as because they're long-term investments, you don't necessarily have to be focused on constantly rebalancing and knowing what's going on. So some of these things, they're structured notes. We've talked about it. I love them. Had a video out this month. Got a lot of my clients involved in the ones I talked about because I really believe in them. I think the terms are fantastic, and it's always great to have protection, right? Especially if you don't need the cash, you're not looking for it within 5 years. So if you have a retirement account and you're not retiring in 5 years, it's ideal for that. All right. Then we're also talking about fixed rate annuities. The Wall Street Journal piggybacked my idea. I call them multi-year guarantee annuities. They usually yield, you can get between 50 to 75 basis points higher than U.S. Treasuries for the same time period. That's fantastic. you don't have to worry about cherry picking and getting the highest rate. And if you think if the Fed went a little bit too much with talking about 2 as opposed to 4 rates, interest rates spiked. This is what you want to get into in fixed income. It's great. Deferred taxes. You can defer the taxes if you keep on rolling the annuities over. Fantastic. It's great. That's another big plus, right? As well as if you have insurance, permanent insurance, you should consider moving the permanent insurance into an index universal life policy. You save a ton of money on fees, but the products in there that you invest in are like the structured notes, but they have full 100% protection for the investment every year. It resets, but you can't lose any money on the investment part. And they have a cap, but the caps are substantially high enough that over time, you're really looking at a 6.5%, 7%. It really depends upon the terms. At Triathlon Partners, we know the companies we know the policies with the more generous terms and with the reputations that they're going to hold it. So from that standpoint, that's something to get involved in because again, long-term investment and you get a lot of ton of tax advantages. All right, I'm sorry, this was very long, but I think it was worth it. This is fantastic. This is gold information. At Triathlon Partners, we like to say we go the extra mile, right? Our Ironman races are 30 miles running, not 26.2, right? So thank you very much for listening. Please subscribe to our videos. Please contact us on our websites, www.triathlonpartners.com. Look out for our new website. It will be online very shortly, theoriginalira.com. That's me, Ira Koyner. Contact us, set up a free consultation to get your financial plan and your financials on the right track. Thank you very much for tuning in. Merry Christmas, Happy Hanukkah, joyous Festivus, and have a very blessed day. Stay tuned for the disclaimers.